Hello and welcome to AI Market News by LM. Before we jump in, a quick note. This video's audio is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. Also, please remember this video does not provide investment or trading advice. Always make investment decisions at your own discretion. Okay, so today we're doing a deep dive into the market action from September 24th, 2025. It really felt like a day where several big forces were sort of colliding, didn't it?
Absolutely. You had this incredible tech momentum, especially AI.
Right.
Then you had the whole central bank uncertainty thing hanging over everything.
And geopolitics making waves again, big ones. Yeah, based on the input sources, the picture was really quite contradictory. You know, the main U.S. indices, like the NASDAQ, down almost 1%, S&P 500 dipped over 0.5%. But underneath that, the convictions seemed really strong. The S&P was still trading, 3% above the average analyst target?
Exactly. That kind of split signals something interesting is going on. So our job here is to cut through that static rigor, right? Try to pull out the real signal.
And figure out why things move.
Precisely. Not just the what equities, the yen, the VIX, but the why. Where do tech, policy, and, well, politics all meet the market? That's what we need to unpack.
Okay, let's start with that AI engine. Because even with the broader market taking a bit of a breather, the AI story, it just keeps running hot, doesn't it?
It really does. And you see clearly if you look at the chip makers. Take Micron, MU.
Right.
They put out a really upbeat forecast. And the driver, strong demand for high bandwidth memory, HBM.
And just remind us, HBM isn't your standard RAM.
No, not at all. Think of it as specialized super fast memory. Absolutely essential for feeding those monster AI GPUs.
So demand for the really high-end stuff is still accelerating.
That's the signal, yes. It confirms the build-out isn't slowing down at the critical component level.
And we saw this energy spreading beyond just the usual U.S. names, too. Alibaba, Bibakia, big jump pre-market, nearly 9%.
Yeah, that was interesting. The CEO talked about boosting their own AI infrastructure spending, plus this new collaboration with NVIDIA.
On physical AI, like robotics.
Exactly, robotics software platforms. And that seemed to catch some eyes. We saw reports that Cathie Wood's ARK fund actually bought into Alibaba. First time in 4 years, apparently.
Wow, okay. So a sign of confidence in their AI strategy.
Seems so. But this brings us to a potential red flag that came up in the data, this idea of circular financing.
Yeah, the NVIDIA and OpenAI thing, that huge investment number being floated, $100 billion for data centers.
Right. The concern is NVIDIA invests a massive amount in OpenAI, and then OpenAI turns around and uses a big chunk of that money to buy, NVIDIA GPUs.
So the investment kind of loops back as revenue.
That's the worry. Is it genuine organic market conviction driving these huge numbers? Or is it more like sophisticated financial engineering to kickstart an ecosystem?
And if it's the latter?
Well, it raises questions about how we value NVIDIA's growth.
Right.
How much is truly organic versus managed? The AI excitement is definitely real, but there are these new, complex financial risks tagging along.
Okay, leaving aside those AI loop concerns for a moment, let's talk about the Fed. We had Chair Powell speaking, and the market's reaction seemed, mixed again.
Powell was very measured, wasn't he? He talked about this two-sided risk.
Meaning,
near-term inflation risks still lean slightly upwards.
Okay.
But the risks to jobs lean slightly downwards. He kept things deliberately foggy, gave no clear signal about an October rate cut.
Right, standard Powell playbook lately, and yet bonds rallied. The 10-year yield dipped back towards 4.12%.
Yeah, and the 30-year too. And maybe even more surprising, the VIX, the volatility index, actually dropped, down almost 2% to around 16.3.
Lower volas when policy is uncertain. Seems backward.
Well, that sharp drop in volatility, especially in interest rate volatility rate swaptions, violent hit lows not seen since late 2023, apparently caused a bit of a mess.
A mess how?
It triggered what some are calling a Volmageddon effect for certain strategies. Specifically, popular quantitative investment strategies, QIS, quant funds.
So why does low volatility hurt them? I thought they liked predictability.
Well, many of these quant strategies are built to profit from or hedge against big spikes in volatility. They might hold positions that essentially bet on instability staying high or increasing.
Okay. So they're betting on fear, basically.
In a way, yes, or at least the cost of insuring against fear. When rate volatility collapsed, the value of those hedges just evaporated. The prepared resources suggested average losses around 2.6% for these kinds of hedges. and it was linked directly to less anxiety about things like Fed independence and fiscal deficits.
So the market calming down actually hurt them.
Precisely. When the uncertainty premium disappears, strategies built on that premium get squeezed. It shows how stability, or even just the perception of it, can be as disruptive as chaos for certain players.
Fascinating. So the easing anxiety, maybe reflected in things like the fear and greed index inputs, ended up creating a painful trap for these sophisticated players. Macro mood swings hitting the micro level.
Okay, let's pivot across the Pacific. Let's talk Asia, specifically Japan. Politics seem to be directly driving the currency and bond markets there. The yen weakened again, USD/JPY climbing towards 148.50. What was happening politically?
It really centered around the LDP leadership discussions and fiscal policy. Candidate Takaichi was debating again.
Right, and her stance.
She seemed to be moderating slightly, perhaps. She emphasized the government setting the policy direction, but the BOJ controlling the means. Still worried about rapid rate hikes hitting loans and investment, though.
And that caution about hikes, that calmed the bond market.
It seems so. Long-term JGBs rallied, pushing yields down. The market chatter about the so-called Takaichi trade, basically, betting on aggressive fiscal expansion forcing rate hikes that seemed to fade a bit.
Why? Just her words. Her words were described as more toned down than maybe in the past. But it wasn't just talk. The Ministry of Finance actually stepped in too.
Oh, what did they do?
They announced another cut in issuing ultra-long bonds. We're talking 15.5 to 39-year stuff. They trimmed the October and December auctions by 100 billion yen each.
A second cut? That sounds deliberate.
Very deliberate. A clear signal they wanted to cap those recent yield surges. So you had this mix, slightly softer political rhetoric on hikes, plus direct government action to reduce long bond supply.
And that combination pushed the yen down and the dollar up.
That appears to be the dynamic, yes.
All right, finally, let's hit geopolitics, because this arguably generated some of the sharpest, most immediate market reactions we saw. President Trump's comments on Ukraine and NATO really resonated.
They really did. The shift in tone was quite noticeable, quite abrupt.
What exactly did he say?
Well, he stated that NATO countries should be ready to, quote, shoot down Russian aircraft, violating their airspace. And, maybe more surprisingly, he sounded optimistic about Ukraine, saying they could win and regain territory.
That's quite a change from some previous comments. A much harder line.
Definitely a hardening stance, signaling more commitment. And the market reaction was instant.
Defense stocks jumped?
Immediately.
Yeah.
The European Defense Index was up almost 3%. Names like Rheinmetall, BAE Systems, Saab.
And not just Europe?
No, global theme.
Yeah.
Hanwha Aerospace in South Korea surged nearly 6%. Mitsubishi Heavy in Japan up over 5%. It just confirms that defense spending is, well, maybe the dominant global investment theme right now.
The numbers back that up.
Absolutely. The MSCI World Aerospace and Defense Index up something like 51% year to date. Stunning.
Wow. Okay, elsewhere on the geoeconomic front, a quieter development with China.
Yes, potentially significant though. China announced it would stop seeking special and differential treatment S&D status as a developing country in new WTO agreements.
And S&D gives developing countries certain advantages in trade rules.
Exactly. It allows more flexibility. Removing that demand takes away a major point of friction, particularly one the U.S. and Trump specifically often raised.
So a potential easing of trade tensions there.
Potentially. But the broader economic headwinds are still blowing. The OECD trimmed its 2026 global growth forecast slightly, down to 2.9%.
And they pointed to
Tariffs, specifically noting that the full inflationary hit from higher U.S. tariffs hasn't really filtered through yet and will likely pressure firms globally. So even as defense stocks fly high on geopolitical signals, the tariff overhang remains a drag. Another contradiction. So if you try to tie all these threads together, AI keeps powering ahead, even with these, circular financing questions bubbling.
Right, distorting the picture maybe.
Could be. Meanwhile, the Fed's balancing act squashed volatility, which ironically slammed some quant funds built for chaos.
Yeah, the vol hedges got crushed.
And then you have geopolitics. The shift in U.S. rhetoric sending defense stocks soaring globally, almost ignoring other macro worries in that sector.
It's a complex mix. Defense up, broader market cautious, AI humming but with caveats, Fed steady but causing ripples.
A very tangled web right now.
Okay, a fantastic deep dive into all those conflicting signals. Before we sign off, let's leave everyone with something to chew on. There was news breaking about Lithium Americas, ticker LTHM. The U.S. government is apparently thinking about converting a huge, like $2.3 billion Department of Energy loan into a 10% equity stake in the company.
Ah, the Thacker Pass project.
Yeah.
Similar to what they did with Intel and the CHES Act funding structure.
Exactly. LTHM stock just exploded on the news, up 66% pre-market.
Yeah.
So the question for us to ponder is, what does this kind of direct government equity stake, essentially the state becoming a part owner in a critical minerals company, tell us about how national security is being redefined?
Especially in these vital supply chains for batteries, for EVs, for the whole green transition.
Yeah. Is this the new model for securing strategic assets? The government not just regulating or funding, but actually taking a seat at the ownership table? Something to think about. Okay, that's all the time we have for today. Thanks for watching. Don't forget to like and subscribe.